Hello, everyone. We have a content-packed video for you today. Reggie and I got together, hit record, wanted to put our thoughts together. And at the end, it just seemed like something we couldn't duplicate again. So we're just going with that version. But what we wanted to do was three main points. We wanted to kind of reset the purpose for our videos. And then we wanted to update some things in the market and where we could talk to principles about investing and things like that and how they're demonstrated in the market. And especially back to that question of should I react to those headlines? And then third, we took a couple of research trips that we've done and kind of pointed out instances where they are related to investment concepts and kind of the purpose of why we have to do those research things in investing. But I hope you enjoy it. And as always, you know, if there's something that you need, just give us a call. Thank you. Right. Hello, everyone. We have us a new video version of this and that we're going to start with. And so it's a takeoff from our this and that blog, if you will, our client communication letter that we've been doing since 2008, combined with a little trial period there with Investor Mindset podcast. But the reality is we aren't podcasting this anywhere. We're just going to do a video here for our clients and share it on our website. But first of all, I should introduce myself. I'm James Pope. And then we have Reggie McFadden down there at the bottom. What's going on today, Reggie?
In the heat of summer. So I think people enjoying vacations, but the heat is here in South Louisiana.
Reggie and I went historically back through the this and dats and the investor mindset and kind of came across a theme, but it's very similar to the subtitle that we have written for the this and that. And so we thought that's where we really added the most value to our clients. And it also allows us to stick to the same mindset when we're selecting investments and strategies and things like that for the clients. But it really is this concept about, okay, my neighbor said this, the news media is saying this, and to step back from that pressure, because the pressure is always that you're doing something wrong with your current investment strategy. When your neighbor says this, or you know your friends and family are doing this and they made all that money, or the news media is saying you shouldn't be doing that. Oftentimes you should be trading a lot more. But just to step back and ask yourself, should I react to those headlines? And from there, I'm going to let Reggie talk a little bit about what that means to him, you know, about the pressures from the press, everybody else, because to me, the best time to make a decision is you go 2 weeks, you know, out into the wilderness and don't hear from anybody and just do your own research, and then you make an investment decision. But that's not really even possible in this day and age. We're bombarded with communications to change what strategy we just took some time and what investment we just did a lot of research in to this newer thing, the newer go out there and, hey, just listen to me, do this, and real easy. You only spent 5 seconds doing it, but you need to make that change right now. So go ahead, Reggie, and add to that your experience.
Well, I think the should I react to these headlines? It's what's current, it's what's relevant, it's what's being on all the news media, and people feel like they're missing out if they're not doing something because of whatever the headline is. It's always changing, and it's puts people in position to feel like they got to do something about it. And as we've seen, these things cycle, and like you said, it could be 2 weeks, it's going to be a new headline. And with all the news media and the talking heads on TV spouting off stock tips, people feel like they're missing out. And the idea that you got to do something about it because you saw something on TV gets you real short term. I mean, it creates an environment that makes you want to do something, makes you want to change. And so when we think about it from an investment standpoint, it is it's always going to be something. In 4 months, we got an election. You got to do something with your portfolio if leading up to that. And that's only 4 months, So this is investing is something that it's over many periods, and to do something so short term really creates a bad environment.
Well, and I would say to add to your point, kind of sparked a trigger there, is that what makes it so difficult is the media, your neighbors, whoever's bringing this information to you, they're going to back it up with what the stock price action was over the most recent time frame. So they're going to back up, hey, the world is ending with, and Microsoft just dropped 20%. Did you see that? And vice versa. Well, the oil price is going through the roof. We're running out of oil. And so whatever it is, the stock price is going to reinforce that your belief that that person has more information, better information, or is just smarter than you. And the reality is, 1 in a billion times you might run over that scenario, but it's okay to miss that 1 in a billion. You're better off if you know the companies underlying it and just realize that stock prices are going to go up and down randomly, and then they're going to make news events after the stock price moved. And so
that's what I was about to say, is that most of these headlines are written based on the movement of the stock price. It's the tail wagging the dog.
Yeah, and so that kind of starts to lead me into giving an overview for this video. What we wanted to do was give you an introduction so that we can keep coming to this over and over when we do our next videos, and we don't have to repeat this introduction. And the second part, most of our videos we started the this and that 2008, so I don't know if a long time. So we're getting in there close to 20 years. We've developed reminders, phrases that can bring us back to investment mindset, because we're not immune from, you have to read some news and things like that. We're not immune from getting those same emotional triggers that everybody else does. So some parts of our videos are going to go into, some of those catchphrases that we've used. One thing we've invented was 7 reminders to bring us back to an investor mindset. And so Reggie and I have been talking, and one of the issues right now brings up our point number 7, which is we're not going to outperform, and an investor I don't think should have as his goal or her goal to outperform every crazy market blip. So right now you have artificial intelligence that has gained the attention of market participants. And the leader in that attention grabbing is NVIDIA stock. And so it's okay for the rest of us to not have a portfolio that beats NVIDIA stock. Because so to do that, you'd have to have one stock NVIDIA, and then you'd have to leverage that. And from my experience, there's no way you can be an investor for the next 20 or 30 years if you're going to do that type of strategy, or any other strategy that would beat the performance of NVIDIA stock right now. And so when you see the impact of NVIDIA stock, well, after the run up, it's high in these indexes and the related AI stocks. So, I mean, Reggie has stats and things to share, but the market, when you talk about the indexes as the market, it's really only talking about large caps. And now if you break it back to today, the performance, the upward performance of these large cap US indexes is very few stocks. And so you're getting into a place where you are over allocating to something you probably don't understand if you haven't bought NVIDIA, 10 years ago, to almost leveraged on that idea. And so what could go wrong? Reggie?
Yeah, I mean, even take it back to 2021, it was a similar mania. It wasn't AI. It was still in the tech, the growth area, and then you had a rough 2022. You way underperformed if you just bought in 2021 and rode it through 2022. We're here 2024, and now they're coming back. But it's easy to look in hindsight and say, "Oh, I could have rode through it because it's up there." But there was a lot of things went out of business. Stock prices are still down 70-80% from some of the ones back in 2021. And so it's easy in hindsight, but you would have, if you overperformed in 2021, you underperformed in 2022, plus in end of 2023 they started to come back, but it's market cycles, and you're not going to catch every cycle, up and down.
Yeah, I guess when you start talking about that time frame, I remember oil at negative $30 a barrel, whatever it went to. All these oil stocks way down. So you had the inverse of the AI situation where most people following index and news and everything else, essentially the globe was underallocated to energy sources. And so you can get both sides of this if you're indexing. And so all the glory to the indexing, and in the underneath that hood of that index are at least some type of committee selecting stocks. So Reggie and I could come up with our own index, but somewhere behind this are human beings making some strategy to create an index buy. And so it's not as inactive as the promoters claim it to be. The benefit for investors is that it could be mimicked very cheaply, and you don't have to know that AI is coming. If you would have been in an index 10 years ago, you would have some of these components of AI now. So you technically have to be more of an investor mindset even in that aspect of holding these things for a long time to really get the benefit of them. You need to hold the indexes 30 years and things to really get the benefit of that. You have to go through multiple cycles, and so to get the reality, you need to go back and look at these indexes and see how much they've fallen when they've fallen, and see if you can handle that.
Well, I think that, it brings up the passive index craze, and these things do cycle as well. And, the only way to really beat the index is to either be different or be leveraged. And, from an investor, being leveraged is on a path to destruction.
Yeah, and I'd like to step back for a second, and something of value really to our clients, to me, is that you don't have to beat the index. And right now, everybody's the index. When they're talking about the index, they're only talking about the S&P 500 now.
NASDAQ,
the people
recently,
right, the people old enough, my age, don't even call it considered a NASDAQ anymore, because I think it dropped like 80% in 2000. Whatever it went down, it was terrible. You couldn't really hold on to it. And
no, I mean
and so right, they're forgetting mid caps, they're forgetting international, and so they think all indexes are performing the S&P 500. What the media does is take the very best index and say, well, you should have done this in hindsight. But I don't know of advisors who would put their clients' money 100% in the S&P 500. And so if you're not 100% in the S&P 500, any other index, you're underperforming.
Yeah, that's a great point. I think the success of an investor is not beating the best performing thing every period. You can be successful as an investor, right? Many different ways, and it's not because your neighbor is quote unquote more successful than you right now. So there's always going to be periods of out of favor, but at the end of the day, the personal investor success is not beating every single index, every single time frame.
Right. Because as we'll see, if you go out a year from now, it's possible that it's a different index that everybody's wanting to beat. And so that's, Reggie just rephrased that number 7 principle. And that's why I want to spend some time on that, because you only get to that freedom of not beating the index and not beating your neighbor when you realize that the actual goal of the long-term investor is not to blow up. So you can't get comfortable with other people beating you until you realize that they may be on a path of blowing up, even if they're 100% media-backed, okayed buying the S&P 500 right now. It's possible that the S&P 500 could go 16 years and not make any money.
Right. Look at Japan. So it's that's the real key, is not finding yourself in a situation where you can blow up, and that is, I don't know where this AI revolution is going, but if you find yourself 100% there, it's not likely that you'll find yourself getting out at the top. They don't ring the bell at the top.
Well, and most of our clients are from the Gulf Coast, and reality is we don't know anything about artificial intelligence to the level of the people who have actually made money on corporations and artificial intelligence. It's usually over there on the West Coast somewhere. Those are the people who saw the companies grow up from when they were small little things like a single Cane's restaurant. That's the type of stuff that those people who've made a lot of money on NVIDIA, Netflix, or any of those things, they've seen them grow up, and they've been invested in it very early. And so if you're buying now, you're their exit. You're their ability to get out. And they're probably moving on to something else. So that brings us to the last section, I would call it, on this video. What we wanted to tie it into was kind of our travel recently. But I want to go back and, before we leave this section, talk about two things. And again, it's probably something we'll bring up in every video to update us on, hey, what's going on now from an investor's standpoint. Reggie, what is an area that you're avoiding? I mean, it kind of sounds like we're avoiding large cap indexes, domestic indexes, but anything other than that, how do you see? There's a lot of talk about inflation and interest rates and things like that. So what are some of the things that you're avoiding? And I want to start there again, same with the same point, because I think it's most important to think about things you want to avoid right now. And so let's start there before we get to some areas that may have opportunity.
Yeah, no, it kind of sounds like a broken record, and obviously it feels like you missed it with the large cap growth, but it seems like there's this gold rush, and you don't know who's going to be the big winner. Right now, it seems obviously NVIDIA, but everybody is rushing to this space, and to me, it's just they're paying. They don't know actually, what they're paying up for, because you don't know who the winner is going to be. You don't know where this space is actually going to end up. I mean, it's so new in this area that when you look at just some of the multiples, it is very pricey from a risk perspective, and especially where interest rates are. You could possibly make a point that they're not expensive when interest rates were zero, but now when you're talking about 5.25, on short-term rates, that changes everything in my view. It's and there hasn't really been a correction that you would think, because the interest rates really in the investing world has implications across every asset class. And right now, when it was zero, you could put money in anything that, and if you get 1 or 2%, you're beating zero. But now you got a higher hurdle, and over the long term, at current valuation, it just seems like they're overstretched. Now, I've said it before, and it did have some sort of correction, but they bounced back. It's just places to avoid. It's not that I'm saying they're going down. It's just really from a longer term investment horizon. I don't know that the growth can keep up.
Well, yeah, I think, to help you out on that point, I think there's investment, there's speculation, and there's gambling. And people can probably, not me, but people who are good at it can probably speculate and make some money off of this AI thing at this level. Maybe it's down. So when we look back 20 years, you look back 2 years from now, somebody will have gotten it right, one of the speculators. But our point of this communication is, even if AI goes up for the next, whatever, 2 months, 2 years, 10 years, 20 years, the reality is it's not very much related to an investment activity at this point. It's more related to a speculative activity or a gamble or something like that. And so maybe you have some outside funds and you want to do those things with, but for us and managing people's retirement and things like that, we want to stick to the investment side of things. So I'll just add my little bit about an area to avoid. To me, what I've seen, and I haven't seen a lot of talk about it, but the yields are starting to reflect not just time, but quality. And so what I'm seeing is there are some yields going up on low quality items. And so my avoidance would be, don't chase yields at this point. Because the economy may be slowing, at least the Federal Reserve thinks it's achieving its objective. But slowing is not crashing or a recession or a depression. And so when you get into those later categories, I'm not saying we are going there, but getting a 7% yield for 18 months means you get back about 10% on your dollar when that company is busted. And so I'll avoid that section.
Back to that point on the, I guess, still call them junk bonds, but the lower quality bonds is, again, for the last 35, 40 years, these lower quality companies have been able to refinance their debt just as interest rates have gone down. And now you're seeing the reverse. So the cost of capital is going up, and which if they're highly levered, that's where, when they can't refinance their debt, is when you see devastation.
Right. And that purposely, that's what the Federal Reserve's doing right now. It's kind of drying up some liquidity where they can't get that refinancing. But before, I'm going to save the opportunities because I think it's more relevant after we talk about our recent travel related to business. We've done 2 recent travel events. and the point I want to make here is that what we're doing is trying to understand business valuation. Not do you know what the stock price of a certain stock is? Is it 100 or $50 or something? But understanding the business mechanisms of what makes a great business and what makes a poor business, and what should the valuation be for an investor to get those types of returns. And I think the first event, and I'll let Reggie explain that, but we saw so many companies, you had this feeling of just pure capitalism, and you really got to understand how capitalism works and the need for companies to have financing to sell stock, to go out there and do bonds and things like that. So I'll let Reggie go into our first trip.
Yeah, we took a trip to Vegas for the microcap conference, and it was kind of brought up because one of the companies maybe we were looking at was going to be there presenting, and they had I think it was right around 100 companies, and it was 2 days. It was a whirlwind. It was probably 10 hours, and there were 30-minute segments giving these companies, these microcaps, an opportunity to present and tell their story. And you had a wide range of companies, from businesses that have been around for 20 years to new IPOs to even SPACs, but really trying to expand the investor base, because these companies have little to zero following on the analyst side. And so it was a way to get their story out and learn about how their business works, maybe what is coming up, where they see kind of opportunities for their business, and reach out to a wide range of investors that they can hopefully get their story out. And so it was anything from 3 or 4 million market cap to 200 million market cap, but just the wide range of different companies. We were able to meet a lot of different investors, from the do-it-yourself investor to investment banks. It was crazy, just the wide range that we were able to interact with, and be able to talk with the CEO, be able to sit down and hear their story. And it was really fascinating, because there's a real opportunity here with zero analyst coverage on some of these companies that are growing really fast, and maybe they need maybe they need financing to continue their growth, and a wide investor base that can help them in that fashion. If they have a better investing base of not just trading back and forth, then they're able to raise capital in ways. And it was a lot, and it was very informative just to see there's so many more companies out there than what you see on TV. And a lot of these microcaps had a very seasoned management team coming from years in this industry, and new management teams that were very seasoned. I was really shocked on that, and I think that's kind of what got me excited is you could see how they're transforming their own business and kind of the runway that they have.
Yeah, I'll get the broad view on this, but first wanted to say it was a lot of work. It wasn't comfortable. It was a lot of hard work. But on the broad view, what you see, again, back to the capitalism, is that a lot of money has taken the easy approach, the lazy approach, and it's gone into large cap indexing. And then I think almost on the same lazy approach side, a lot of money has went into private equity now. And so what you have is these small micro cap companies are surrounded by private equity, where a lot of money has gone into over, say, the last decade, and then a lot of money has gone into indexing. And you can't really make a good index for micro cap investing because a lot of the companies won't make it. They'll the odds are stacked against them. But repeatedly, Reggie and I saw some opportunities where companies, because of the opportunity, some managements are leaving larger companies where they were extremely successful and getting into these because the valuation is really cheap and they think they can execute. They've proven that they can execute at a different company. That takes a lot of digging to go through, and so it's not an efficient market. And, summing it up, coming back from there, that the efficient market hypothesis isn't right. If you go and spend some time in this area, that it's just, it doesn't work in that fashion. And so there are opportunities, but the problem is they're ugly, they're hard to get to, it takes a lot of risk, and it takes a lot of risk if you broadly do it and don't do that research. And so I think for those reasons, professional investors and individual investors alike have just left this area to die. And usually when that happens, there are some opportunities there because every company here, every opportunity, every management team gets painted with the same brush. And obviously for huge managers, it's not worth their time to come down and look at microcaps, even though they have the skill. I mean, there's that Warren Buffett quote where he promises you he can get 50% a year if he only had $1 million to manage. Well, that's because he knows there are opportunities down here. It's not easy, but with hundreds of billions and close to trillions of dollars, it's not worth anybody's time if they have that much money to go down there and figure out which company is decent, which company's great, which company's horrible.
And it is. I think it's gotten, I say a bad name, but people stay away from it. Because like you said, there's it's a size thing because Goldman Sachs or whoever, even Warren, like you said, Warren Buffett can't really even invest here. There's a lot of speculation because maybe they're $2-3 stocks and people are just speculating on pure price. And there is you have to weed out a lot. There's a lot of, I say pump and dumps, but the sole thing is trying to just get their stock price up. And so you really got to distinguish the real businesses with the real operators and the speculation, because you think it's a lot in large caps. I mean, it's tenfold down there, and there's so many to weed through, and it's exciting because if you can find the real businesses with the real operators, there's fantastic opportunities because there's no one chasing them.
Well, I think that is hard too, and luckily we kind of came from it from the other area where, we've looked at large caps and mid caps, and we know, we have our favorites and a list of what characteristics make our favorites, and so we have that to drop down to. But yeah, when you get down here, there's a lot of promises, right? Because their current business isn't where they want it to be. It's, hey, what do we do in the future? What growth opportunities are there? And there's a lot of distractions because you can hear things like, well, we're about to get a contract, but the contract never comes, or the contract comes for half the profit. And so you can always go down there and get distracted very easily and away from that great business that you're trying to see if you want to be an investor. So again, with the distractions, there's a lot of events that are happening that you could buy this stock, and based on current price, maybe there's a 50% move in there to the value of their assets or something, or if this contract comes through or something like that. But that's different from one of these companies that you are looking for to maybe hold for 10 years. Because a lot of them will just trade up and down as, things get exciting, or they make a dividend distribution or something like that, or they have a good product and then the product fades, and their own new product wipes out the demand for the old product. And so you see a lot of cycles down there.
Right, and it's back to, I guess, the investing mindset of what we've been trying to preach is they're volatile in a sense because there's not a lot of volume. There's wide bid-ask spreads. You could have 5 shares traded and you're getting crazy moves price-wise. And, back to the investing mindset, it's not focusing on price. It's the business. And so people stay away from it just from a volatility perspective, or they're worried about, the next quarter or something like that. So you do see a lot of volatility. It takes, a real thought of business analysis.
Yeah, and I think, back to one of our other points, for most people, this area is just something that Reggie and I can share as an area of opportunity and explain how we think sometimes the price is different from the actual value of the business. But it's okay to avoid this. You don't need to invest in microcaps or anything like that. So the other point for us, what it does show, when we get back to our favorites characteristics, it shows the value of a moat. When you go down there and learn that these companies are trying to make their moat wider, but it really gives you a lot of studies. If you're sitting out there with a large cap drink company, there are a lot of businesses aiming for you and the profits that you're making off of those popular soft drinks right now. There's a lot of companies. If you are a real estate agent, broker, there's a lot of companies out there trying to disrupt that model right now. And so to us, that's our benefit even if you never invest in one of these companies, to going to an event like that, is you see how these markets are changing over time, the competition that's coming, and brings us back to that there's an innovative and a destructive cycle to capitalism. Anything there, Reggie?
Sure.
You want to go on to our next big thing, related in the same point, because this, we're going to say the name. It doesn't mean to go buy it. It doesn't mean to go sell it. And we have no advice that we want to share right now on this company. It just happens to be one of our largest holdings, and we want to stay up to date on it. Okay. And so what we can demonstrate that's helpful in investor mindset is that there's a business underlying it. And this one tends to be extremely hard to understand just from reading the financial statements. And so our second trip was to a company that's a land company called St. Joe. And you really have to go put your boots on the ground to kind of understand it. And this wasn't our first time there. But also what's developed around that is like a mini Berkshire Hathaway, where Reggie and I find other people talking our language, the language of business analysis, and not just, hey, this stock price made some technical formation, and so it's going to break out. And if it doesn't break out, it's going to break down. There's a lot of other people there, other analysts, other investors that more successful than us that we can learn from. And so that's another reason that we went take a trip out to St. Joe. And I'll turn it over to Reggie and share your thoughts, your experiences. What were some of the things that you didn't understand or new things about Joe that you really had to go visit there to understand? So go ahead.
Yeah, it was really kind of the whole area ecosystem of how they think about the land that they own, what's going to be the most beneficial, what are they missing that they need to add to this area of growth, because it's seen rapid growth from the migration. And it was just how thought out the board, the CEO, the CFO was on taking their time and developing this the right way, where they control who comes in, who goes out, and can develop their own ecosystem in the way that they see. They get a lot of feedback from the area's population, kind of what they need, what they're lacking, and just the ability to take this and grow it out over 30, 40 years. It's get a lot of it's a real estate company and interest rates are higher. Yes, that's true, but there is no shortage of demand in that area.
Yeah, and I think one of the demonstrations they showed us was a new hospital that's coming into the area. And there's another company at that micro cap convention, that was in the land. And we learned that the importance of the counties in okaying a plan and a plan of development. The counties basically have to okay your plan. And Joe had to get two counties to come together for their land to develop it out. And they also had to get them to agree on a long-term plan. I don't know if it was 50 years. But you can see that because they have a community there of retirees, and there was no real hospital. There is no real hospital close to there, and so they want to build an excellent hospital there so that the people, the residents in that community, can access health care.
And it was with, being with Florida State too, it
top notch.
A pipeline as well as top notch, but you have the research aspect of healthcare. It's not just the older people, but just the research, the pipeline of doctors with the Florida State name on it, and being able to create something similar to, I think Baylor University or something in that area that has the whole, or UT Texas and Houston, I think has a huge healthcare facility that kind of creates this cycle of getting the research along with serving the members of the community. Like you said, I think the closest one was hour and a half away for these, retirees, older population that nobody wants to drive an hour and a half there and back just to go get your, healthcare needs taken care of.
Right. And so that's still a development, and lots of room. I think they have some numbers, but there's a lot of development left in the land that they have. But I wanted to just kind of wrap it up. I wanted to add one opportunity. Reggie kind of demonstrated the lack of a market efficiency in pricing microcap companies. I wanted to go on the other end of that and say I think the market expectations have become so high recently that it's important to take a step back and realize that right now, short-term treasuries out to maybe 5 years are 5%. And so to me, that was what the recent this and that was about, was realizing that there could be an investment opportunity in some things that people don't think are investable. And that's always the case to me over long time frames, is that it can't be very popular for it to be a great investment. Usually by the time it becomes popular, the prices have gotten too high. But I think a lot of people are trying to speculate right now, and they're passing up on some decent 5%, very low risk opportunities. And so
I think,
with that, Reggie, you got any wrap up kind of or thoughts about that?
No, I mean, it's a great point because back to it, the market expectations, and I think looking out a little bit longer, that there's a high probability that you'll find better opportunities. And so with the 5% shorter term treasuries, it pays you to wait. If there's no rush out there, you can kind of pick your spots, if you will, while still earning, 5%. And so it's that thought that there's no rush to really you can kind of wait for, like Buffett says, your pitch. You don't have to swing at all of them, and really be patient.
Right. I think if you look at things and say, okay, I'm only going to invest in large cap United States stocks. Historically, there have been times where there's quantity-wise, there's a lot more opportunities than there is now. And so as things cycle, you have to think that there's a possibility somewhere in the future that there are a lot more opportunities than what there are right now. And so if you're limited to large caps, and the dividend yield on average there, I don't know what the S&P is now, Reggie, maybe 1.5, but you can at 5% in short-term treasuries now. So with that, I'd just kind of like to wrap it up. Did you want to say anything else, Reggie? Anything else?
No, I think that's it. I know we went down a wide range of topics, and it's first try, and just kind of going off the cuff of what we're seeing in the investing world currently, and try to take it and get it to kind of current perspective.
Yeah, great job. I think, this is enjoyable for me. And obviously doing the research that we've done, the 2 trips weren't into bad locations, to say the least.
Yeah.
So those were enjoyable, and meeting fellow investors that we could learn from. So with that, I'd just like to say thanks for watching. Be safe. We look forward to doing more of these. And keep your investor mindset. Thanks a lot.